starting these at 7 o'clock now. A bit of feedback, a bit of thinking. We thought, you know what, let's move these from 6 o'clock to 7 o'clock to allow anyone who's working, doing other bits and pieces to settle in, grab a drink, whatever you need to do so you can enjoy kind of an hour of beautiful webinar content, and then you've still got the final hour to trade. So how are we doing, ladies and gents? Good evening to you. It's a pleasure to have you here with me this evening. Today we're talking about the trade, the timing edge, but I've got a lot of stuff to cover. We're changing formats, we're doing things differently. I want to share loads of things with you. So without further ado, we'll get on with it. And then we'll talk about the markets. We'll talk about Jay Powell, and we'll talk about this, and we'll talk about that. And we'll talk about obviously the trade timing edge. So first of all, let me introduce myself. I know I've got some new people here who maybe haven't seen me before. My name is Mark Holstead. I have been trading for 22 years. Actually, no, it's not even 22 years. It's 25 years it will be. So a couple of decades plus. And, you know, I'm here to kind of share with you on these webinars specifically. I'm just a guy. I'm a trader. I'm a guy who likes talking about the markets. I like researching markets. I like obviously trading. I like sharing information that I found, and that's really my objective with these webinars, is to share with you ideas that are going on in my mind, things that I see other traders doing, inspiration from others, thinking different mental models, different strategies, different ideas. And so that we have a real mixed bag of kind of content in these webinars. And from now until the end of the year, so from now until December the 23rd of December, we're going to be running these every Tuesday. Then, okay, things come up, but generally speaking, they are penciled in for every Tuesday at 7 p.m. UK time. The clocks go forward, right, on the 26th of October. So that screws me up no end, while the American clocks don't change at all. We have it's 1:30 open, normally 2:30 open. When does data come out? When is this? When is that? But anyway, the point is that we do it at 7 o'clock, regardless whether on British summertime, which is a bit of a joke right now. It's not very summery. And then we go to GMT. So taking you right through to the end of the year. And let me share with you some of the topics that I've got planned for you. Today, obviously, trade timing edge. Next week, we're going to talk about asymmetrical trade hunting. So, we'd always talk about the probability of success versus risk reward ratio being, you've heard of 2 to 1, 3 to 1, etc. Risking 1 to make 3, risking 1 to make 2. How do we find those trades and where are they located, so that if we are trying to trade that type of way, so with decent risk reward ratio, where do they occur and how do we spot those and how do we trade those? Deciphering market rhythm, AI edge, so more real world use cases for traders. There's a big updates on that. I kind of share irregular thoughts and ideas on that in my daily email. I try and do it once every couple of weeks if there's been some sort of update, and remind people of different use cases. So we'll collect all that on the 4th of November, day before Guy Fawkes. Trading models for busy professionals. So I know many of you work, many of you doing other things, running businesses, have jobs, etc. And so we're going to kind of cover ways that you could perhaps be more involved with the markets and kind of hit some of your goals in trading alongside other things that you've got going on. Not everyone is able to sit in front of the screens. If you want to sit in front of the screens, not everyone's able to do that. So we're going to cover some stuff there, talking about confidence, talking about impulse management, talking about trade management tactics, scaling in, scaling out, pyramiding, that type of stuff. Got a good challenge for you on December 9th of December, 30-day AI trading challenge. Many people love AI, the idea of it, but this is a challenge to really get it cemented into your routine. Like I tell you, ChatGPT now is just revolutionized the way that I journal, revolutionized the way that I come up with ideas, trading ideas, come up with kind of research data stuff. So I'm going to give you a challenge to help you blend it into your trading routines that becomes a habit. And then a final, no, it's not quite the final. We're going to do lessons from studying the greats as we go into the sort of beginning of December. And the final one will be the 2026 preparation workshop, where we'll go kind of do a bumper session. We'll talk about targets, systems, mindset, goals, kind of to get some momentum in for the new year. So a lot of good stuff planned. If you're new here, you will enjoy it. If you want to see some of the previous webinars I've done, go to my website, tradersmastermind.com. Somewhere on the top, wherever they put it in the menu, webinars section, they are all uploaded there. When we get the recordings, they are uploaded there. And also Pepperstone will upload them to their YouTube channel. So thank you to Pepperstone for doing that. Whilst we're on the subject of Pepperstone, I don't want to keep going on about housekeeping. However, we need to talk a little bit about the risk disclaimer. And I'll tell you what we're going to do and how we're going to do the format and everything. So quick reminder, ladies and gents, please, that, and I know everyone's like, oh, he says it all the time, but I'd like to say, even though I have to say this, but I like to say this because there are many traders who I know are new, relatively new. And so, you know, I'm not the type of person who's going to stand there and tell you that everything is all rosy and all you've got to do is this step-by-step process and everything is going to be great and you're going to make loads of money, because it's simply not true. It's a tricky journey, trading, and it's a risky journey. And many people who have been here and been in with me and shared these webinars and been in my community and email and stuff for years know the journey, and you know they're kind of getting some progress and they understand the challenges that go through it. But new traders, kind of, there's a flashing light, oh, this looks really, really good. To just be aware of the risks involved. You know, it's a risky business, especially when you're trading with leverage, you're trading on margin. Anything like that just amplifies the gains. Great, that's why we're in the business. They also amplify the losses. And so please, please, only trade with money you can afford to lose. Only trade when you understand the risks involved, and only trade when that becomes gap risk, that becomes size risk, that becomes all that kind of stuff. And just really appreciate you know, why we're doing this, and understand, you know, can use a demo account and all that type of stuff. And I know I've gone on about it, but I just, you know, it's something, there's not many things that, you know, get to me, but I just hate to hear of people coming into the markets, you know, and not really knowing what they're doing, and then going, oh, I didn't realize that was going to do that. It's like, fine, come in and go through the learning curve, and you know, you're going to lose some money when you first start out. As you start to build your progress, that's fine. But I just hate to hear people coming in and not really understanding the product industry and their trading. So I know I ramble on about it, but hopefully, you know, understand why. Let's go back a slide. What we're going to do is I'm going to talk about a trade timing edge. First of all, I want to spend 10 minutes or so, and I want to spend 95 minutes already going through the market. So every week now, hopefully, we'll be like, okay to do this. 10 minutes, fast track through the markets, what they've been doing, where the next move could maybe be, and it's never going to be advice, of course. We'll do that for a bit, then we'll go back to the slides. So we're going to mix stuff up a bit. So if you come on these webinars, hopefully get some live stuff where we're looking at what's happening right now, some of the things that are interesting right now, some of the markets still at levels, etc., that sort of thing. So that's what we plan on doing as we go to the end of the new year. First slide, go to the slide, go to the charts, then we'll come back to the rest of the slides and finish stuff off. Trade timing edge. I was going to read you an extract from good old Toby Crable's book, but I won't this time. I'll save you. We'll get straight into the charts in a moment. But a great quote from Jesse Livermore here is, don't trust your own opinion and back your judgment until the action of the market itself confirms your opinion. Now, maybe people confuse that with waiting for confirmation, as in, oh, I need to see the market rallying and taking out highs before I get long. Not always. Right, it's a confirmation for your trigger. That might be just an ignition candle. That might be a reversal candle. It might be an engulfing candle. It might be time of day, price being whatever it might be. So it's just have your idea. Remember, this is a game of chess. We're thinking multiple moves ahead. What does the market need to do to corroborate? Said it right. There's a bit of a tongue twister. The trade thesis that you have, and Jesse Livermore was a master at kind of coming up with these one-liners and ideas and concepts. I'll really thoroughly recommend the book Reminiscences of a Stock Operator if you haven't read it. If you've been trading for more than 6 months, 1 year, and haven't read it, what are you doing? Absolutely must read. It's a great book. No, seriously, it's worth going. It's pennies on Amazon now. I think I've got it as a paperback there, but really good book. So now, a lot of traders glamorize Jesse Livermore. He had a bit of an unpleasant ending, shall we say. However, the trading part of it, you know, there's some lessons there. He was probably over leveraged a lot of the time, and maybe he's put on a pedestal a little bit too much. But if we look at some of the ideas and the approaches and learn from kind of some of his mistakes and some of his successes and failures, then, you know, even though he was around the 1930s, is still applicable today. Okay, today talking about a trade timing edge, of course, how timing, time of day stuff helps us look at better trades, time them better. I'm going to give you some statistics, some sort of data that I've got. I'm going to kind of talk about the volatility windows, all this type of stuff. Okay, before we do that, let's go to the charts, because I want to run through the markets. Won't spend long on this, but I kind of think, you know what, we're here, you're here now. Stuff is happening. It's pretty interesting out there. So, you know, we need to kind of look at what's happening here. Okay, so let me share something else, which will be the window. It'll be, have I got silver? Okay, I happen to have silver up. That's strange. Let's start with the Nasdaq. Jay Powell has just said, I'm just going to read this from FT today. Signal support for more rate cuts as U.S. job market cools. Federal Reserve Chair says inflation expectations are close to blah blah blah. Okay, so he's ready. He's signaled he could be ready to support another interest rate cut later this month. Right. We're not well, maybe you are. I'm not a particularly fundamental trader. However, I like to know what other traders are looking at. One thing they're looking at, of course, is the interest rate cut cycle. We're assuming we're going to have this cut. We're looking at what Jerome Powell says. That's important. The other thing is obviously what Donald Trump is saying with the tariffs, with the tweets, etc. And the whole bull market is kind of propped up by the AI. Hey, it's going to revolutionize things. Productivity is going to increase. Earnings are going to increase with companies. And so we have this scenario, right? And, you know, whilst I'm not interested in digging into the weeds and reading any more on that article, I probably will do it when I'm later on in bed flicking through just to see what's actually said. But from a trader's perspective, that's all I need to know. It says good news come out of that. How's the market responded to that? Now, we have a little bit of a spanner in the works. We have a little bit of a pollution, if you like, into the recipe. Pollution into the recipe. There you go. Pollution into the recipe with Donald Trump on Friday. Now, quick recap. You probably heard all this and read all this type of stuff, but let me kind of go over it from a sort of trading perspective. So this is the playbook that he's been doing for quite a lot. And I've got the Nasdaq futures up here, by the way, in a 5 minute. I think you guys can see that. Let me do that. There we go. So this has kind of happened quite a lot, where Donald Trump has come out on his Truth Socials, has been shared on X, and effectively this was a kind of an attack on China, you know, a verbal attack on China. Later on, he backpedaled, as he often does on the Sunday night, and said, hey, you know, I like China. I want to be friends with them. I don't want to hurt them, blah, blah. The point is the market is super sensitive to this whole tariff thing, right? We thought we put it behind us. If you go back into, let me put this on a daily. If you go back to kind of the April time here, you know, we had a lot of action based on tariffs because he was just kind of setting the stall out. A lot of deals were being done, and it was all over the place, right? And we've kind of got over that. The market's kind of calmed down a little bit. Deals have been done, etc. But this has really spooked the market. And why it spooked the market is, I think, more than the tariff comment on saying we're having 100% tariffs on China, they've got a deadline. He was responding to the fact that China is going to start to restrict some of these exports of these rare earths. And I think the market thought that market didn't really react to that, which is interesting. But then afterwards, I think the market realized when Trump actually did the tweets and he did the kind of post on Truth Social, hang on a second, you know, China might be doing something here that's going to blindside the US. Today, we'll talk about today in a moment, but I think that's really what happened. And the fact of the matter is, there's a lot of people who are waiting for any kind of rug pull. There's a lot of liquidity events happening where some of these moves are kind of exaggerated, because at the moment in the modern markets, you know, we get a lot of volume, we get a lot of algorithmic activity, we get a lot of kind of repeating patterns. And when it happens on Friday and you take out multi-day lows and there's a huge amount of volume coming on the sell side, you know, very often people have no choice but to trim the exposure, because they're thinking, okay, I'm going into the weekend, regardless of whether Trump is going to tweet something else, I'm taking on risk. Do I really want to kind of be max risk? A lot of people will peel off that exposure. So I think the moves are generally exaggerated on a Friday. And actually, if you go back and look at some of these charts, you will see that actually very often these exaggerated moves do happen on a Friday. Okay, so where are we now? So we gapped up on the Monday. Fine, let's look at the Nasdaq. We gapped up on the Monday. Today was, I think, the telling day, because the gap on the Monday, people were saying, oh, you know, we didn't really gap up enough. And the markets tend to creep back to highs, right? They have a rug pull to lows and they tend to creep back to highs. So, you know, I don't think it was unusual for us to do that on the Monday. So today is more telling. because we had a really horrible overnight move from a bull's perspective, right? If you're bearish, absolutely great. Let's go to the just move you here because my window is here. We had a really horrible overnight session. Yeah, push lower, push lower. The opening bell came up. I don't know why I've got an exchange time. That's just going to confuse my brain. Let's stick on London time. Yeah, we had this overnight session, market open, flush lower, flushed out all the buyers, and then rally. And this rally is pretty strong. Now, NASDAQ is lagging slightly compared to stuff like the Dow, and the Russell is really rallying. But if it closes up here today, and I appreciate we've got some time left, this kind of sets the tone a little bit. Now, I think we might get a little bit of volatility contraction. If you go back and look at some of these kind of moves that we've had before, go back to the daily, when we've often had this move, we often get a few days of volatility contraction before the bigger move plays out. This one here, we kind of had a bit of a kind of nothing, and then we resolved slightly. This one here had multiple days. This one here had that kind of shudder, little bit of a kind of inside days, and then we resolved that way. We had, where was the other one we had? I don't think I've pinpointed it out, but this little shudder here, a couple of inside days, and then we chopped about. But the point is, we might get a volatility contraction. So we'll see where today closes. It's an outside bar at the moment, definitely on the NASDAQ. It's also an outside bar on the S&P. It's a very strong bar on the Dow, and it's a super strong bar on the Russell, now pushing back to all-time highs. That is obviously fueled by the fact that Jay Powell's expressed that he will cut rates, or looking to cut rates further. The smaller caps are more sensitive to that. I think the NASDAQ's been a bit hammered by Nvidia not doing so well. So what are we kind of doing? And by the way, this is not advice, no trade ideas here. We're just kind of workshopping through where the markets are and where they possibly could go. Now, I think that it's too easy to get caught up in seduced by the volatility. The ranges are big, huge range on Friday. Monday was a bit of a look round and see, gap up. We sat there and did nothing really. We gapped up and sat there and rotated around the VWAP. Today, big range. Can it hold? I think that's the key now, is can this hold? And have we has that spooked or sucked a few people out? Are they now having to chase back in and pushing this market back to highs for the classic kind of push into the year end? Is that what people are thinking? Is that how they're playing it? Now, if you're a bear, you would probably, you'd probably want to see these lows taken out before you even thought about a trade. Like if you're a bear, I think, and now listen, I'm not going to tell another guy how to trade, but I think if you're bearish on this, and the question's got to be, why would you? I get it, but I think you'd want to see some price action to support that, maybe taking out today's low, maybe taking out the Friday's low and doing some business down there. If you kind of did the where's the old brushki, if you had this kind of scenario here, then maybe that's a good opportunity to go, okay, maybe we're just kind of doing a little bit of a pullback into the year end. I think that getting bearish right at this point, could you ever stop above the high? Yeah, I mean, maybe you could, but I think it needs to resolve itself. It needs to work out, what's going to happen here, what's going to happen here. Now, one thing to add on this is that because we've had the good news coming out supposedly from Trump at the weekend, we've had this supposed good news today from Jay Powell. If the market starts to roll back over, let's say the latter part of the week or tomorrow in the latter part of the week, that will be quite telling as well. Now, I don't think that necessarily it's all hands to the short side unless we kind of get another day like Friday, and of course maybe use an intraday sort of method to get on that. I think from that perspective, then you're saying, okay, this should be good news for the market in the fact that there should be rate cuts on the horizon. However, the market's not really bid up and it's still at a discount. So discount to where it was last week, and now we've got good news. Is that something to be cautious of? Maybe it just means we're going to sit in a holding pattern for a while. Yes, as unfortunate as that sounds, that might be the sort of edge case that everyone's kind of calling for the high, everyone's calling for a flush to lows. We might just sit around and do nothing for a bit while it digests. People don't want to take risk off. People don't want to take risk on. So that's a possibility, right? Or we're off to the races again. Maybe the Russell kind of leaves us higher, bizarrely, and we push off when its normal bull market resumed, and we get that squeeze into the year end. But I think that when you've also had a big volatility day, you've kind of got to be careful you're not seduced by the volatility. It's too easy as an active trader, day trader, whatever, active swing trader to say, hey, you know what, I like this, I want to get involved. There's going to be plenty of opportunities this week, and there's going to be plenty of opportunities next, and plenty of opportunities the week after. And then we've still got plenty of time for the month. And if you're a day trader, an active swing trader, whatever it might be, I think that being mindful that things can change very quickly with your P&L to the good and the bad, and being patient enough to say, hey, I like the swings here, but I just don't see something that fits me. And maybe that's you, right? Maybe that's you. So let's see where things close today. Markets are, we're looking pretty bullish ultimately, right? So let's see how they resolve today. Gold's interesting because we had that shudder. It's actually not the day before the Trump thing, on Thursday. We've now carried on squeezing higher. This looks relentless. There's nothing, seems to be nothing stopping this rally. It will stop at some point. Of course it will. Do we have an exhaustion move higher? Do we stagnate a little bit and flag and then do one more press? Do we build up a Wyckoff spring type trade? So something I'd love to see, I don't know if we're going to get this, would be kind of a consolidation for a while. The spring that gives us a kind of springboard off into kind of one more final flush. That will be quite nice to see. And from an intraday perspective, you could trade that from an intraday perspective, looking for that support to go and then push back to highs. Silver is absolutely on a tear. Massive wide range days. I'm a little bit cautious of silver. I don't really feel like I have a good grip of what's going on. I'm always tempted with these things to be mindful of a big rug pull. Silver strikes me as a sort of thing, and I didn't strike me. I've seen this before on silver. We get these massive down days out of nowhere. And so from a day trader's perspective, I think it's worth setting the alerts. And I talked about that in one of my emails, being prepared for these volatility expansion days, so that if you are an intraday trader and something is getting battered, you're like, hey, I like trading bear flags intraday. You want to bring that to your attention. So yeah, let's kind of see how it resolves today, see how it resolves the rest of the week. DAX is doing okay after that little dip below. It's still this period of indecision, right? And even though we have people are nervous about these rug pulls, I think there's a period of indecision there. We look at some of the currencies quickly. Yen, that breakout is pausing a little bit. We're still within the thing. I think the general rule of thumb here, we'll kind of end on this, is that Friday's range was big. I think we need to see the market testing the upper or lower end of that range to really kind of have some conviction on where it might go. Now, could it fake out through that and reverse? Of course it could. Could it break through and continue either way? Of course it could. But as traders, we don't want to try to guess this type of stuff. We want to say, okay, I want to see who the winner is of the supply-demand battle and side with the winner. That's kind of ultimately, and try and trade what I think is going to be easier setup than predict which way we're going to break out of it. I think there's a valid argument either side, probably more slightly to the bullish side at the moment, but who knows? You still got the headline risk, of course, from Trump coming out saying something out of nowhere, which you've got to respect. Would you trade in position for that? I don't think so, but you definitely protect your butt and you make sure that you've got stuff in. So in play, I think, is NASDAQ, Russell, if you're a Russell trader, gold, of course. Those are the three things that are in play. You could do the trade the Dow, of course, if you prefer to trade that way. One final thing I want to share with you. I'm going to share with you some intraday stuff actually in the slides, so I won't go over it too much today. But very often we have this, get rid of that. We have this scenario where, and if we do have a rug pull again, watch out for this. We've got 1 minute, and guys are going, oh, 1 minute. This is something that I think is quite curious and interesting. When we see this on the Friday, okay, if we have a rug pull, we saw this in gold on Thursday, we see it on Dow on the Friday, and NASDAQ on the Friday, and every index. If there's some sort of news and it happens to be that type of thing, very often we get this grinding lower. It struggles to push higher. Distance from the VWAP is pretty high. This here, when we have in the final sort of 15 minutes, 30 minutes of trade, an attempt to push higher. This is one for you kind of active day traders. This push lower, this attempt to push higher that fails, that's often a very good high probability trade. Because if that's, a lot of people are thinking that's the bottom, it's going to rally, we're okay, we're saved, and then it starts to roll. Very often that shudders very aggressively into the closing bell, because the closing bell is obviously, some of the options can't trade and all that other type of stuff. So something to be aware of. This kind of heavy down day, tries to push up, fails, rotates lower. We kind of got a little bit in gold on the Thursday when there was that rug pull. Not saying it's kind of a prediction of when the trend could change, but if we do see that liquidity event, and we may well see that one with silver, we may well see that with gold, we may well see that with some of the indices, depending on whether some of the headline stuff comes out and if Trump is saying things. I think these little intricate things are worth studying, little intraday patterns are worth studying, because there's opportunity there to say, hey, there's a 15-minute trade here, 30-minute trade here. Let me capitalize on this repeated pattern of people panicking and getting out of a very, very small door, because we know everyone's long. We know everyone is long gold. We know everyone is long silver. We know everyone's thinking that. So if we do get this rug pull out of nowhere, as an active trader, our job is to identify that and go with the winner. And the winner is obviously there. Hey, we've got a lot of supply coming in. Supply. Little bit of demand. Sellers see that as an opportunity to get a real bit of a premium, get slammed back again. I think that's a good intraday setup to look for. Okay, let's go back to the trade timing edge stuff. Just click that button there. So yeah, there's interesting stuff going on. The point, I think, is that be strategic about when you're going to deploy your capital and when you're going to make risk-based decisions, regardless of whether you trade intraday, regardless of whether you trade on a higher time frame. I think the very best traders are prepared to miss some things, but are very clear on what they want to see before they even engage with the market, let alone trade. Do you want to see the high break and the low break before you even consider a trade, let alone decide on the trade idea? But maybe that's the same intraday. Like, I just don't want to. I want to see these levels break before I even consider a trade. And so, guessing direction is not what we're in the business of. We're in the business of finding repeatable patterns that we believe, if we took that 1,000 times, would give us a positive expectancy. And so, whatever that looks like for you is kind of, I think, where to focus your energy on over the next kind of couple of days. And then obviously, because the volatility is potentially high, I think we'll get a volatility crush. And then over the next week or so, going into the end of the month. Okay, so let's talk about trade timing. So there we saw a lot of kind of higher time frame charts. Let's go down the time frames a little bit now. Let's dial it down a bit. Why I think timing matters. So many traders will just look at the setup, and there's nothing, obviously, the setup's prices. If I was going to have a tattoo, I'd have price on my face, probably not my face. I'd have price, because that's just been my North Star. It will always be my North Star. And as I kind of alluded to before, looking at some of the headlines and stuff, I'm interested in how price is responding to what's perceived to be good news or bad news, how price is responding to levels, how price is responding to being marked down at the open, right? This type of stuff. And so that's important, but also we need to add an extra layer in. Many of you here are intermediate traders, advanced traders. Even if you're beginners, it's worth kind of understanding this concept before we move forward. Being so obsessed over price is good, but there's also an extra layer in, and that is the timing of the trade, right? Because when you are timing the trade when the conditions are going to be aligned with your trade idea, you're timing the trade with when you expect a mean reversion event to happen, you're trading mean reversion. You're timing a trade when you expect volatility expansion, range expansion to happen. You're timing it with the time of day that you expect that to occur. History has shown you we have had range expansion, volatility expansion this time period. So then, would we want to trade that type of trade? Yes, we would. We want to try and fade stuff? Maybe we wouldn't. So it's this kind of thinking about, okay, I want to time my trade as well as I possibly can. And how do I use the market's history and probability to really help me guide me into that so I'm aligned with the conditions. Now, first of all, context is still king. Of course, context has to be king, right? We can't be trading trend trading strategies in a market that's doing absolutely nothing. So, higher time frame structure. Where are we in the higher time frames? Well, at the moment, a little bit tricky because we have the rug pull, the bull market is still intact. We're buying good news. Do we respond to this? Let it resolve if you need to, so you can cement the context and say, yeah, bull market back on versus, actually, bit of a kind of risk-off event happening over this week. I'm going to position for that. So higher time frame structure, really important. Sentiment and positioning, I think, is useful to understand the sentiment, and that is, hey, what are people feeling at the moment? Ironically, when people are saying this bubble's going to burst, is super bullish, because when you do have that and people saying, oh, you know, this is the end, this is the top of the market, blah blah blah, very often it's absolutely not. You've got plenty more to go. There's people who are still short. It's when those shorts capitulate and go, well, maybe I should buy this thing, that's often the top. And by the way, I'm looking at these higher time frames, even though if you're a day trader or a kind of intraday trader, it still pays to understand the higher time frame context, because that should align your direction for how you're going to kind of, you know, position intraday. Are we in a volatility regime of expanding or contracting? Friday, big expansion. Now we're kind of contracting a little bit. If we break out the high or lower Friday, Russell slightly different, of course. Do we expand? Do we kind of break out, sit there? So it's that intraday expansion, contraction, and based on the chart patterns and based on price. And what's driving the market right now? If we look at the indices are driven by AI is going to transform stuff. Got obviously this bull market. We've got the rate cuts. We've got liquidity flying into the markets. Everything is looking pretty rosy at the moment, and that's okay. That's what people are looking at. That's what people are responding to. And so, just understanding that, and just like I said, you know, we're bringing up some of the comments from Jay Powell there. If the market starts to sell off on positive comments, you've got to be a bit aware. Then you'll be like, okay, that's interesting. And that's when maybe things are slightly different and the sentiment shifting. Okay, so context is king, and timing goes on top of that. It's the final filter. So you can have the best setup in the world, but if you trade at the wrong time of day, you're going to get chopped up, or worse, but not a great thing, you have to risk way more than necessary. And what I mean by this is if you're kind of trading you know, some kind of reversal pattern and you're trying to trade at the open, the range is like swinging around, you're going to have a really fat wide stop on that. And then how do you have your target? You're looking for a massive target to justify the risk reward on that trade, or do you have a target that should be defined by price action, in which case you're risking way too much? You might have a negative risk reward. So you kind of want to make sure that you're not risking more than you need to, because if your stop's going in a sensible place, then you want to kind of align when, hey, you know what, volatility is contracted, I think we're going to peel back, this type of stuff. So let's have a look at some of the breakdown of I'm generalizing here of how the markets ebb and flow. And I'm coming at this from a perspective of, I'm based in the UK, so this is UK times. I'm based in the UK. I trade the Western products, i.e. US, almost all US stuff. But I talk about the DAX, I talk about FTSE, that sort of stuff. Those of you who are trading maybe Hang Seng, Nikkei, or some of the currency pairs in the Asian session, then this will differ for you, but I didn't want to kind of put loads of stuff in. There's still going to be that session where Nikkei opens, you've got the Asian session range, you've got this and stuff, but I'm just focusing on Europe and the US here. So early London, 7 a.m. to 8 a.m. This is kind of when people start getting to the desk in the city. They're in there from kind of 6 o'clock. Money starts moving around. You know, you start to see cable moving around sort of 7 a.m. 8 a.m. is when the bell goes, stocks start trading. That's when kind of price action really kicks in. And you can kind of see the volatility pick up and volume pick up at 8 o'clock. So 7 until 8, we've got this initial response to overnight news, maybe pushing a little bit lower, maybe people positioning a little bit, starting to get some deal flow through. I'm a big fan of this type of stuff. You know, I'm very cautious about how and by the way, it's not me telling you how to trade or saying you should do this, but let me just share with you maybe some of my thoughts on this. You know, I'm very focused on the US session if I believe there's opportunity. And so I don't tend to waste resources, mental resources, in this early session, but you adjust and adapt based on how you want to trade. Some people like trading that. Rob, for example, you know, trader in Trades Mastermind, he likes trading that early DAX session, probably not so focused on the US session. So early London, 7 to 8 a.m. pre-market stuff. 8 o'clock till 9 o'clock, often get liquidity spike, volatility expansion. Now I've noticed, and you may have too, is that this may not do too much if America did not do too much or there's not much going on. We tend to take the lead from the Americans. We tend to look at the American market and go, okay, we will probably do this. Now, you might look at the charts and go, I beg to differ, Mark, and fine. You know, it's not a perfect correlation, but generally speaking, the biggest economy in the world is going to have a knock-on effect. And that's why we tend to follow sort of how the Americans are trading. So London time, 8 o'clock to 9 o'clock, that's when we get the kind of adjustments, highs and lows tend to form. The mid-morning time, 9 to 11, that's when the day type becomes a little bit clearer, I think. Like I say, I'm more focused on the US, but it's the same type of thing, right? That sort of couple of hours after everything's settled, is it going to be a choppy day? Is it going to be a rotational day? Is it going to be a trend type day? I think that becomes clear in that mid-morning. Then we've got pre-US data, so often we sit there and wait for data. If it's data-driven day, 1:30 p.m. that comes out. People are either just peeling stuff off, rotating back to VWAP, that type of stuff. US Open happens at 2:30, and at 2:30 or 4:30, I think is when you get, strictly speaking, the Open really sort of 15 minutes to an hour. And if you've kind of studied Toby Crable and his stuff here, that's when really stuff's kicking off. However, I think that for the first 2 hours, we might get kind of fake out some bits and pieces, but there's a volatility expansion, I guess is the point here. Volatility expansion during that US Open, lots of volume flow coming in. Why? Stocks are open, options are open, loads of other stuff is open, loads of deals are going on, algorithms are active. The futures market's much more liquid. You see liquidity coming into the market. So that's the peak, right? And we've still got we've got the US session open, and we've got the European session open. So 2 hours there, whereas everyone's chucking money about, able to do all sorts of deals. That's when we've got all the volume, all the flow, all the volatility at its max. Then we have the kind of drift in the afternoon. US session, again, similar to the morning session in the European bourses, where we kind of work out the day type. Talk a little bit more about time with day stuff, because I've got some things to share with you. And the final power hour, as we call it, the final hour when we get the final push on the trend day, like we saw on Friday, or it does a VWAP magnet day, and we'll talk about that in a moment, or there's just kind of exhaust and sits there and does nothing. So 7M to pre-open probe, talked about that. London Open, is when volume comes in, institutional order flow, often get traps. This, I think, is something to mention here, is if you are trading a volatility expansion strategy, I keep bringing this book up, I didn't intentionally do this, like an opening range breakout, obviously you're going to trade at the open. That's why this works, because the volatility expansion tends to happen at the open. And if you can time it correctly, just like you saw here the other day on the FTSE, that opening candle pretty much showed you where price was going to go. That's not always the case, by the way. I don't think that's something to look at. But there you can see the volatility expansion, the volume come in as well. So if you're trading that, looking for a further continuation, looking for momentum, you want to align with the open. One extra thing here is if you have a multi-day hold, I like to wait for the open to see if there's potential for, a further day. So if I've been long, for example, on this day you can see here, I would kind of say, okay, let's see what happens at the open. Let me get a judge of the character of the day, because there might be one more day of juice in this trade. And so if you're kind of that sort of trader who holds for multiple days, I think the open can be a time to wait for, to kind of get that range expansion and go, okay, that's a nice little bit of juice. 9 to 11, same day here, screenshot. I think this is when the day's character starts to reveal itself. Is it going to be choppy? Is it how much has it done trade around the open? The opening print's pretty key. 8 o'clock, all using the 2:30 US bourses open. Bong. What's the open like? How's price reacting to the open? If it's chopping around the open and it's still doing that at kind of 10 a.m., 11 a.m., the day character. You don't want to start, unless the US kicks things into gear, which often can do. You don't want to start trying to be smart buying breakouts, because not only is volume decreasing during that time period, volatility historically decreases. So again, you're aligning your strategy with the tendency of the market historically and with the current context you're in, right? If you say, hey, we're in a different context today, we're kind of breaking out there, fine. You've judged it as a trend day. You think there's an opportunity there to get in, you do that, but just know that you're going against the kind of history there. All right, next one is we have this US data coming out 1:30 p.m. Now, often we'll have two things happen. And obviously, there's multiple data points that come out here at 1:30, and obviously check your economic calendar before you kind of understand the headline risk on the day before you trade. But something I've noticed happen is that if the data is a surprise, then very often we're going to get some sort of significant move, especially if it's tier one data or red book data, as some people like to say. So CPI, FOMC is slightly later in the day, but anything that kind of comes out, NFP that comes out and is a surprise, very often that's going to create a new regime. Market's going to reprice itself, or something's going to happen. Now, That's rare, and most of the time what happens is data comes in line, because generally speaking we don't we don't miss, or we don't hit, or we don't, I'm talking from an earnings perspective here. What's the terminology I'm looking for? We don't beat, we don't fall short. I should be on Bloomberg with this articulation, but you get the idea. If the market tends to get it right and what their estimates are going to be, and what will often happen is this the day type will resume. So if it's been a trend day, we might stagnate for a bit. 130 does a little bit of algo, you've seen it before, kind of the spread goes a little bit wider in the underlying market, and with the broker, bit of flicking around, and then we resume, normal service resumed. And that's just that pause. So often something to consider is, if we don't have an extreme out of expectations for the data and you're maybe flat, then what was the day type before? Was it rotational or was it trending? I'm expecting that to continue. But bearing in mind that the 2:30 open only an hour after this can change things dramatically. And so watching out for that volatility, expansion, contraction. And something I talked about before, not to go off piste here, but I'm trying to jam in loads of stuff at you, and I appreciate I am today. But the volatility, expansion, contraction is really in tune with the time of day. And I think it's something that the more I think about it, the more I think that that's something that trips up traders without realizing. Trying to trade breakout type trades when the volatility is high, but actually all it's doing is cycling lower. And that happens intraday and kind of on a higher time frame. So just being really aware of that. Where's volatility? Expanding, contracting, etc. So 2:30, 4:30, talked about this before. Peak flow, good for you taking those opening range breakouts. I won't bring the book up again, don't worry. Those kind of fake moves, we talked about the open many times before, and I've shared some strategies for that. And something interesting, the 6 p.m. is often a swing point. And what I mean by that is very often something shifts at 6 o'clock UK time. And the last 3 days, just wanted to see what happened and bring it up for you. So you can see on the Friday, even though on that heavy down day, we had a bit of buying coming in for about 30 minutes at 6 o'clock, pretty much on the dot. 6 o'clock was the high print on the Monday when we had that choppy day after the gap up. And today, 6 o'clock, I actually took this screenshot just before 6 o'clock. We kind of just stagnated a bit. In fact, what have we done since then? We kind of stagnated a little bit. And even though we didn't come off too much, where are we? Yeah, we stopped the rally pretty much at 6. We're a little bit before 6, actually, about 10-2. But the point is that something's happening at 6 o'clock. And so if you are long, let's say you were long today, and well done if you were, then, and you're an intraday trader, you might be like, we're probably going to stall out at 6. I might take some chips off the table, unless of course you're looking for a kind of close move, fine. But just be aware that at 6 o'clock things shift. They often shift at 4:30, which is the UK close. Not sometimes, I think that it goes in cycles, right? Sometimes you see it very obviously, but 6 o'clock is, very often where we get some kind of counter trend move. I used to trade this thing called the 6 o'clock shock. It's not been so good because it's been a massive kind of bull run the last year or so. But that 6 o'clock, something is happening, some counter trend algo is being kicked into gear. And even though the volume sometimes is lower, we very often we've got a stagnation, so we didn't get a pullback. But very often you get, even on Friday, that heavy down day, we got 30 minutes of pretty aggressive rally before it shut off. On the Monday, we got 30 minutes or so of selling that tried to push back to the VWAP before it could go. So 6 o'clock is worth putting an alarm for, setting an alarm for 5 to 6 at least. So if you're already in a trade, I'm not necessarily suggesting that you trade a counter trend trade, but just being aware that something is happening at that point. And then obviously we talked about the 8 till 9 o'clock fade or flush. And one thing I want to share with you, I don't want to run over this too quickly, is the VWAP magnet play. So we saw on Friday, obviously, the trend just really continuing because it was Friday, because it was a reprice, because people were scared of the news. Everyone was trying to get out before the weekend. That was a perfect storm for shorts while we saw that rally that failed. Pretty rare having those days. We're blessed with those now and then, but they're pretty rare. But, again, this is where the day type will often come into its own. So if you frame the day type as a rotational type day, then very often that final hour of the day is going to be a VWAP magnet. And so VWAP being the benchmark for institutions, often price will get sucked back to that and it'll want to close out the VWAP. Depending on the day type, of course, but if it spent some time rotating back and forth, you might find a VWAP magnet close. Now, I wanted to share with you some data, and this is taken from a free tool, actually. I'm going to get the name of it. It's called Lux Algo High-Low Location Frequency. And if you go on TradingView, you can just put that into indicators, right? This gives you a little window. And why I brought this up is it shows you exactly over the last however many days. I've got here 717 days, and I've got 143 days to show you kind of recency and years. And this was for the NASDAQ. And I just took the Qs, by the way, which is the NASDAQ ETF, just so we had the regular trading hour session. Just an example, you go and have an experiment with yourself with it. Look at the time that the percentage of times we hit the high. This is what it shows you, but I should tell you, so explain this a little bit more. It shows you the time, percentage of the time we've hit the high or low of the day was at that point. Try articulate that better. So at 9 o'clock, so exchange time opens at 9:30. In this scenario here, since December 2nd, 2022, 37% of the time, the high has occurred in that 9 till 10 o'clock range. So in reality, it's going to be 9:30 till 10 o'clock. 44% of the time, the low has occurred. Okay, so it's telling you how often the high or low has occurred over that time period that we've looked back on. I've got 20th of March 2025, and I've got 22nd of December 2022, just to show you how it's similar regardless of how far you go back. Now look at this. Very often, this is why it's important to understand this. And by the way, use this tool. I'll give you the kind of link for it in a moment. You can find it yourself, right? Use it for the market you trade, whether you trade the currency pairs, whether you trade whatever it might be. Understanding the rhythm and the time of day and its importance. Look how often in the last couple of years, the low has been in that first 30 minutes, really, because the market opens at 9:30 Eastern time. So 44% of the time, that's been the low of the day. Now, that's interesting, right? You may know this might be the first time you're kind of thinking about this type of stuff, but these historical tendencies and time of day data really helps you align. So let me ask you this question, right? If you were short, and okay, different days are different, fine, I understand you're going to get these outlier days like we did on Friday, but historically, if it's a normal type day, the market kind of push lower at the open, would you want to be pressing shorts based on historic data? You probably wouldn't. You're probably like, yeah, you know what, maybe not, because 44% of the time that's been the low of the day. Now you could argue to me and say, well, actually, Mark, look, 37% of the time it's been the high of the day too. Exactly. And my point is that very often, if the high or low is going to be put in at that first 30 minutes, use that to your advantage. If, like, I mean, today is a perfect example of it. If you see something that looks like it's reversed, you can quite often say to yourself, I think that's the low of the day, because historically, generally, I know it's not a massive percentage, but it's really skewed in that way, right? That's probably going to be it's a good chance of that being the low of the day today. And so when you position, you think of that and say, yeah, this is probably going to go in the bucket of 44% of the time, because the price action's right, this is right, the context is right. And so understanding kind of where time of day, where highs and lows often occur in the market you trade can be very, very useful for positioning and for holding trades as well. And mentally, you can say, okay, listen, look, in the last 143 days, moving to the right-hand side here, 20% of the time, the high has been in the last hour. The high has been in that last hour. We close at 4 o'clock Eastern time, right? So the 3 till 4, 1500 is that last hour. And so if you're long, and obviously we've been in a bull market, fine, but this is kind of statistics to back up the charts and the pretty pictures that come with price. If you're long and happen to be long, then maybe you want to stay long. You say, you know what, 20% of the time, this is if we haven't put a high in yet and we're still with the right environment, I probably want to hold to the close. I probably want to squeeze that last little bit out. And similarly, and so you get the point, right? So the idea here is that we use this time of day statistics and data to support our trading decisions. So often if we're kind of expecting, oh, I think it's the high and it's midday, you might be like, well, midday, is it going to be the high 5% of the time, 8% of the time? You go back and look and you go, well, it's not normally. So maybe there's the trade opportunity, but I might only want to do an A to B scalp. I don't want to be smart here because 6% of the time over the last couple of years, that's been the high point, and the market is reasonably strong. I'm not going to overstay my welcome here. I might take a trade, but I'm not going to be smart about it and try and overthink things. So this is really interesting and important. And you can do this data yourself. You can plug it into ChatGPT. You can do it that way, or you can get it from this. I'm going to give you the name of it. I'll try and put it in the actually, I'll tell you what it is, and I'll share the screen in a moment so you can see that. And I've got nothing to do with these guys. I just think this is a cool tool, so worth checking out if you've got TradingView. Okay, let's wrap this up. So time of day. Note what time of no. Let's not wrap this up yet. We've got one more thing to consider, then we'll wrap this up. Okay, we talked about time of day for the market, aligning your trade and trying to understand what the market conditions are. Expansion, contraction, open, pre-market, data, resumption of trend, VWAP magna, and then the statistics of when the high of the day often occurs, low of the day often occurs, mapping that with context, yada yada. And you thought this was just click a button when the green light comes on. This is what trading's about, ladies and gents. It seems complex, right? But we're trying to distill it down into some sort of simplicity rules for you. But there's a lot to consider, and this should be right. This is not an easy game, and this is why people struggle at it. So let's talk about you now. Now you need to know when your best trades occur. So look at the time, go back and look at your journal and go, you know what? I like to trade at the open. Well, maybe you do, but if you're losing money at the open, why the hell are you trading at the open? Why are you trading at midday when you're losing? And this is where you kind of be smart and say, hey, me as a trader, how do I link up with the typical oscillations and a rhythm of the market that I'm trading? Am I trying to force a trade in the wrong environment? If that's the case, then actually I'm happy for you, because you've found something that's going to help you get through to the next level. Because if you would say, hey, you know what, technically I'm buying this break, the flag, it looks great, and you go back and go, yeah, but I'm doing it in kind of the middle of the day, and why am I doing that? Because volatility is contracting, and we've got the ATR in this, and statistics show that that's probably not going to be the high. You start to put these pieces of the puzzle together, and you say, well, maybe I need to avoid that. Or maybe I'm just not very good in volatility expansion markets. Maybe I'm better in their contracting.Maybe I'm better when I can have a tighter stop. And so this is when you go through your own journal and your own playbook and your own document, or your own blotter, and work out, hey, is there something there? Well, I'm not very good at this. Well, is it because you're trading the wrong strategy, or is it because that type of environment doesn't suit you as a trader? This is an easy fix if you can find it. And so then you go, right, let me see if I'm aligning with the right conditions. Am I taking this? Am I missing this piece of I'm trying to trade momentum type trades in time when momentum is least likely to occur based on history? Now, are there outlier days? Of course there are. We saw on Friday, completely random day, coming out of nowhere, and have a separate playbook for that. But generally speaking, we have these ebbs and flows. We have the pre-market move. We have the spike at the open. We have that 6 o'clock kind of shuffle for 30 minutes. We have that VWAP magnet if it's been a rotational type day. Understanding how the market rhythm flows and rolls intraday, if you like, helps you align with that. And then your job is then to go, okay, listen, I'm not very good at that window. If I remove that and just traded these, would my performance improve? If it is, congratulations, you found the easiest fix on planet Earth. I'm not trading this time, because actually I've gone back and historically, I know that time doesn't suit me. If I look back and I remove that time, what my stats look like? Wow, revolutionize them. Great, there you go, simple. And so, this is taking it one step further. In real world trading here, guys, we go, okay, what's your performance like? And if you're at a desk, first thing I do is I say, come here, let's see, what does your performance look like by strategy, by setup, by time of day, by instrument you're in? Is there some low-hanging fruit that we can look at and go, you know what, that instrument doesn't suit you, or that time of day doesn't suit you, or that strategy doesn't suit you? often the data's there for us to see, but we're blind to it because we're so focused on the next trade. What's the next trade? What's the market going to do? What's this going to do? And that's important. Of course it is. But sometimes the data is there and it with time of day stuff. So think about creating this timing checklist. When do you expect volatility to kick into gear with the market you trade? What is a really good time window for your idea? And as you say, thesis, actually, not these, apologies. High quality time window. So if you're looking for a mean reversion, do you want to trade it at 6 o'clock, expecting that to rock back? Do you want to wait for the final hour that it stops and stalls and there's a pin bar and then pulls back to the VWAP? How do you want to trade that? And working through that, thinking about this. Mistakes, forcing trades in dead zones, you know this. Trading choppy markets, barbed wire, as it's often called, dirty candles, as I like to call it. There's no edge. There's no positive expectancy there. You're throwing money down the drain. Not understanding your market's rhythm. I think whatever you trade, whether you trade dollar yen, whether you trade cable, whether you trade NASDAQ, Russell, gold, whatever. I understand they're in slightly different phases, some of them now, but generally speaking, understanding the market's rhythm. I'm ignoring the session transitions and misjudging volatility contraction periods. Talked about that before. So timing is key. You can't control the outcomes. We know this, guys. Market will do what the market does. It will go wherever it wants to go. We can't control that. We can control when we trade, what we wait for, what sort of time we're looking to initiate the trade. End of the day, start of the day, midday. How does that fit in with our idea? What we expect the market to do, where our stop loss could be, where our target could be. And I think if you master timing with price, then you get a much better edge. Okay, we've covered a lot today, maybe a little bit much, and I've slammed it all at you. I know we've done some market look at some markets. We've kind of gone through a lot of ground, and I know I've covered these slides relatively quickly. And so maybe next time a smaller number of slides, let's say. But the recording will be out, and you can kind of go over stuff. But my objective is always to really give you so much information. You pick and choose what's right for you as a trader, wherever you are in your journey, whatever resonates with you, the style you trade. You know, you can see I'm passionate about this stuff, and I've been doing it for long enough. Unfortunately, found the thing that I loved pretty early on in life, which was great. And so, sometimes I get a bit excited about sharing this stuff with you and going over things, but I will share things with you that I think are going to move the needle. Okay. I'll answer some questions. I did promise you I would tell you what that tool is called. It's called, you know what, let me share the screen here. There's a couple of questions coming in. Send your questions in, guys, if you want to ask me a question. We've got a few minutes. I won't keep you too long. If you have to go, I appreciate that. I'll try and get to everybody. Let me share something else. Let me go to window. Let me go to the YM review. Let me share, and you can see it there. It's called Lux Algo High Low Frequency. So you put in Lux Algo High/Low Location Frequency, and it looks like this. You get a little window here, and so if you put it on regular trading hours, and in fact I like to use QQQ because you have to understand what time it's doing, and if you're doing exchange time, so you would do diamonds for Dow, you would do SPY for S&P 500, etc. And then you can go back and you can say, how far back am I going to look? 5,000, 1,000 takes you back to the 20th of March, 2025. And there's all sorts of parameters. You can play around with that as you wish. But you can see, look, high, low, percentage of the time. Lots of times it was high. We've had the low of the day. And you'd expect that in a bull market, right? Low of the day at the open, high of the day at the close. So, yeah, that's a cool little tool. Like I said, nothing to do with those guys. And thank you thank you to those people for writing it. Okay. Hayden Rubin, okay, let me get you here. Mark Jockner says, hey Mark, I understand volatility injections and timings, opens, news events, etc. When there's top-down analysis and I'm on my 1 minute chart, is it daily levels I work against? Is it daily levels I work against, or is it hourly levels that I actually look to find 1 minute entries on? I understand the daily is context and narrative, but is it hourly pullbacks I'm trying to time on the 1 minute? You could use an hourly, absolutely, but what you're trying to, if we focus on that mark, which is I'm trying to buy a pullback, So let's run through very, very quickly. Let's see if we can do it in 30 seconds, how we might do this. We want to be the daily chart we're expecting to close. If we're buying it, we expect that daily chart to be a green candle. Is anything stopping us doing that? Have we got some sort of resistance to the upside on a daily time frame? Are we breaking out? Are we in a volatility contraction phase? All that sort of stuff. Context. Is there data coming up, etc. We want that big fat green candle. If we're buying a pullback intraday and in 1 minute, it doesn't matter whether we're doing it for 10 minutes or 10 hours, we still need to see that candle. That's going to help us the most, right? Because if we're in a doji type day, that's when we get stopped out. We're going to be too smart with stuff. So you're then looking for some sort of momentum, 15 minutes, 5 minutes, hourly. I think personally, and listen, everyone trades how they want to trade. Personally, I think hour is too much, right? If you're trading in 1 minute, that's probably too much of a higher time frame. You want to time it on a 1 minute. You probably want to go 15 minutes and say, even a decent 15-minute bar, how does that look on a time frame I want to trade it? Because if you trade the hourly, then okay, maybe you can have a one big hourly candle and then go to a 1 minute to time the pullback. But if you're saying I'm timing the pullback on an hourly, I think it's difficult to judge. Here's something, guys. I found this way, and you can kind of take it or leave it as if it works for you or not. If you have too much of a disconnect between time frames, I think you lose calibration. Maybe that's just me, but I look at my daily for context, and then people look at 4 hour one. Yeah, fine, that works for them because they trade off the 1 hour. But if I'm executing on the 1 minute, then I'm going straight down with the context and saying, what's a 5 minute look like? Because I care about the day, yesterday and today, 2 days worth of action in my 5 minute price window, and then I'm going to maybe execute on a 1 if I'm trying to do that. I don't think that looking at the hourly or 4 hourly and then execute on the 1, I think that ruins the calibration. You kind of have a disconnect of like, well, I've got 10 days worth of stuff here, and I think it ruins it because you don't really care what happened 4 days ago unless it's a key level, of course. And so it doesn't, you've got the context already. You've got a context filter, whether you take 4 hour, 1 hour daily. I like the daily, and then you've got your execution and going down to the kind of smaller time frames. Oops. I don't know if that makes sense, Mark. Gary says, thank you very much. Alison says, absolutely brilliant webinar, Mark. Thank you. Appreciate that. Alison, the final question from Felix. Are there typical indicators that the 1 p.m. New York time reversal is likely to be extended and not just a stop hunt and then continue the morning direction? Asking because is it then worth holding the 1 p.m. trade into the close? Felix, the best thing to, I like this question, right? Because this shows you're observing the market you trade. Double thumbs up from me, pal. It's exactly the right thing to do. You don't find these little nuances and little shifts by reading a book. You find it by watching price. Exactly what you've done. You say, hang on a second, there's something here. And a great example of that is Rob, name's on the webinar, this 7 a.m. candle that he would like to trade. He would observe that 7 a.m. candle on the DAX would often be indicative of the future direction. And he observed that just by watching price. So watch price, just what you're doing. The thing to do here, Felix, is to maybe go back and just eyeball it, because and this is kind of counter, I think, to many sort of typical advice, if you like, but if these rhythms come in play, they come in clusters. And so very often you'll get a reversal at a certain time for 5 days in a row, they don't disappear. And then it'll come back and maybe you get 3 days in a row. And as active traders, that's okay. But if you're there testing it for multiple days out, I know it's slightly different for the highs and lows thing because that tends to be a theme rather than a kind of an ignition. If you're testing it all the way back, then often you're going to get data that is, you're like, well, there's no edge there. But if it's happened every day for the last 5 days, you're like, hey, there's some sort of algo here kicking in at 1 o'clock, some sort of reversal algo kicking in at 6 o'clock. I'll trade it. I'll use it. We had one the other day, Trader and I discussing an algo coming in on the Russell at a certain time. He's not been around for a while, but he was there. Bang, 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 bang every day, same time, weird time. And you could trade that because you spotted it early. So as traders, we are trying to identify edge. So if you identify something, Felix, I wouldn't worry about overthinking it. And again, you take your own risk-based decisions. I'm definitely not here to tell you how to trade. But if you spot something, go off the recency. How has it performed the last few days? And trade that. If you're a day trader, I think that's so much more important than the guys who are going back and back testing something for years and years and years, because that's how markets operate. Algos will be doing this type of thing, and they'll be kind of stop hunting maybe, or moving one, however you want to call it, and they'll shut off and it'll be normal and it'll come back in. And so you want to build this little playbook and document file of, hey, I've seen this algo. And then when you're watching price during the day, you're like, hang on a second, is Mr. 6 o'clock back? That he is as well. All right, I know what I'm doing with that. If I see it start to move, I'm in. I'm gonna, and you can trade it accordingly. So I know I've waffled a lot there, but hopefully that you see what I'm saying. The idea here is that rather than gathering loads of data for some observation you've got, then I think that it's worth. Obviously, you can use that tool, you know, for Lux Algo if you want to see if there's. That will only show you the high of day or low of day though. Just eyeballing it and saying, what's price doing at the moment? What's the regime we're in, and can I adapt to that? And can I profit from that? And it's kind of as simple as that. As long as you cap your risk and you understand, you know, stop losses, which of course I know you do, then I think that recency is so much more important. And again, this is very personal, and you know, I iterate, you know, again that, you know, people trade differently, but I'm a big advocate of, like, if I see something happening 2 days in a row, on the third day I'm probably trading it. And what's worse can happen? I take a stop. What's my stop going to be? I'll work it out. I'll plan the trade. But if I see some sort of time of day algo kicking in, I'm not going to wait for 50 days of it to occur and then start to trade it, because it'll probably stop. Or some sort of, I'm using a time of day algo as example here, but it could be some sort of price action. You know, very often for ages we had this kind of rug pull at the open and they will bid up, rug pull at the open, bid up. It's like, okay, that's what's happening. Let's trade that. If you observe something, trade that. I hope that's helped, Felix. I know I've gone on a little bit there. Valentin says, thanks for a great session. Regards. Appreciate that, pal. Mark says, Mark, that makes a lot of sense. Maybe the hourly in 1 minute is too large a part. I think so, Mark. To be buying hourly pullbacks. I'll test the 15 for a couple of months. I just realized there are 60 1-minute candles in the hourly chart. That'll definitely ruin my calibration. Yeah, and exactly that. And maybe you feel the same. It's like you're seeing a different thing. And even though it's the same price, obviously you're seeing way too many. Like I guess what's an analogy? Looking at something with the naked eye miles away, you're looking at it through a microscope. We're looking through binoculars, right? It's the same thing, but you're looking at it through a different lens. It's like, well, geez, you know, if you were in the sky, you're in a plane, you look down, it looks way different than when you're on the road. Not the best analogy, but you get the idea. And I think the thing with trading is you want to condition yourself to understand the, you know, see patterns that are reoccurring and stuff. Okay. Mark says, Mark, you need to write a book. You're one of the rare pure price action guys. A lot of guys aren't pure price like this. You know what, Mark? I may well do at some point. At the moment, you know, I like to share the stuff with you, but I appreciate that. I know you said that with I know you said that because you appreciate the stuff that I'm saying. So thank you, and I'm glad that you like it. A lot of institutions are footprint and delta and ladder type traders. Yeah, and you know what, that, you know, a lot of the prop guys from, you know, 20, 30 years ago were brought up on the ladder, and the ladder, I've used the ladder for kind of almost a decade before I kind of binned it off. But there's value to that. But I think now in this current environment with the algos and stuff, unless you were brought up on it, you put it this way, you don't see many kind of traders, old school bund traders and bubble traders and what's it traders just trading off the ladder. Do they do it? Maybe they do. Maybe there's desks somewhere secretly doing it, killing it, and they're keeping quiet about it. But I think for the typical retail trader, you're understanding price, relationships with price, and, you know, levels and how news impacts it without going too macro. I think that's enough. And I think that, you know, going away from the textbooks and looking at the market you trade and becoming a specialist in understanding nuances, like, you know, Felix is saying he sees this, or you see a time of day algo, that's edge. I think that's edge, and that's what we can beat some of these bigger guys who are super well capitalized, got the brightest minds. We can beat them because we can respond quickly, and we can say, you know what, this is probably not enough for some big investment bank to get on, or this isn't, you know, this isn't enough meat for an HFT. It's not the HFT realm. This is maybe even not the quantitative trading strategy realm. There's edge here for you and me. There's edge, and we trade it, and we make some cash hopefully, and we cap our risk, and we look for the next edge. And Thomas says, thank you, sir. Okay, ladies and gents, thank you so much. I know I've overrun by 10 minutes or so. So we're back 7 o'clock next week. If you like this format, let me know. Reply to my daily email, let me know, give us some feedback. If you like us talking through the charts, we'll do some more of that. If you don't like it so much, then maybe we'll stop it. I'll go with it. I mean, it's democracy. It's not a dictatorship. It's not a dictatorship. So if you think we do that, we'll carry on doing it. If you want more time on slides, we'll do that too. Anyway, let's see where we close today. Have a great trading week. And Russell up 1.9%. All right. Rally on. Let's see where it goes. All right, guys, take care. See you in the next one. Goodbye.